What's up guys, I'm Paul and welcome to the channel. So it's getting more and more expensive to live here in the UK. The cost of everything is increasing, and most notably it's increased a lot over the past 12 months, and people are facing a serious squeeze on their personal finances. And if you've watched or read anything to do with the UK economy, you're probably going to have heard of inflation and interest rates. And if you're not sure what all this means and what this means for your wallet or your bank account, or whatever you want to call it, where you store your money, even maybe under the mattress, what I'm going to do in this video is hopefully explain what inflation is and also interest rates, and how these two things are interlinked, to hopefully give you a bit more of understanding of what's going on with our economy. So the first thing to talk about is inflation. It's the word that's on everybody's lips.
Inflation.
Inflation.
Inflation is inflation. Inflation.
Anybody who's anything to do with finance at the moment is talking about inflation, because it's got a lot of people running scared. Now, if you're not sure what inflation is simply how much the cost of goods and services increases every single year. And really, we do want things to increase in value over time. And this is where you get people of a certain age, and I'm starting to fall into that category, who say to younger people, I remember when you used to be able to buy so-and-so for a certain amount, and now it costs whatever. The main thing we seem to reference is Freddos here in the UK, because I remember when you used to be able to buy those for 10p. That seems like a long time ago. But that's basically what inflation is. It's how much the cost of goods and services increase every single year. And as I say, we want a little bit of inflation every year. But the problem is, when things go wrong in the economy, inflation can start increasing at levels higher than what we want them to. And they can actually soon start outstripping the growth of wages and things like that. And currently in the UK, if we look at the Consumer Price Index, which is what we use to track inflation, and basically what this does is they bundle together a load of products and services and track how these things increase or decrease in value over a period, usually month to month, and then they look at it over a year. Now, there is also a secondary consumer price index that also factors in housing as well. And that one I think is the more accurate one, because we all have to pay for where we live. So when it comes to the CPIH, which is the Consumer Price Index plus housing, for the year to December 2021, inflation grew by 4.8%. And this is higher than what the Bank of England want. They really want it to be around about 2% every single year. So we're over double what they really want. But when we start to break this 4.8% figure down by sector, it soon seems quite low. Now, there are some sectors where this hasn't increased to the 4.8%. So if we look at food, for example, food across the year in 2021 grew by 4.2%. But when we start looking at other things, specifically housing costs, things start to increase quite a lot, because the average house price in the UK is up 11.2% across 2021, which is a big jump. Then if we look at rentals are up 8.5% across the year, and the average rental property in the UK now costs £1,064 a month, which is a lot of money. That's a lot of money to be paying out of your wages every single month. And then we look at energy costs, and this is the one that has got a lot of people worried. And if we look at the 2021 inflation figures, electricity was up 18.8% and gas up 28.1%, which is huge. And people are really starting to worry about paying their bills. And in 2022, this is going to get even worse, because Ofgem has raised the cap to £1,971, which means the average household could be facing an increase of 54% on their energy bills in 2022, which honestly, I don't know how some people are going to be able to afford that. And things have also increased outside of our houses as well. When we look at our transportation costs, the average second-hand car in the UK has increased by 30.5% in 1 year. 30.5%. So it's worth nearly a third more today than what it was a year ago. That's insane. And then we look at the cost of actually running our vehicles, and those are scary as well, because petrol is up 22% and diesel is up 21% for the year. So when you start looking at all of these figures for the individual sectors, that 4.8% overall figure seems really, really low. And this is because when they're figuring out how much inflation is actually going up, they do discount certain things. They exclude outliers, so things that have increased a lot or decreased a lot, they exclude these and they just look at a kind of average overall, which means we don't really get an accurate reflection of what inflation actually is here in the UK. And really, it's probably a lot higher than the 4.8% that they're saying. So as you can see, the UK is getting more and more expensive to live. But what are some of the things that can be done to help curb this inflation? Well, that's where interest rates start to come in. Now, interest rates are set by the Bank of England, which is our central bank here in the UK. And the Bank of England has already started raising interest rates. In fact, they were one of the first central banks to actually start working towards curbing inflation, because we've already had 2 rate hikes here in the UK and we're up to 0.5% as of recording this video. But there's more rate hikes planned and they're going to go to a minimum of 1% this year. And I think they're going to go quite a bit higher than that because they need to. They need to start curbing inflation. But how does raising interest rates start curbing inflation? Well, it all comes down to how money moves around our economy. Because when the Bank of England raises interest rates, what they want is retail banks, you know, the guys we bank with every single day, to pass those interest rates on to us. So our money starts making money when it's sat in the bank. You know, not like the abysmal rates we've got at the moment, but we actually start getting some return on our money, thus encouraging us to save rather than spend money. And what they're hoping will happen is when more people are saving money, it's going to reduce the amount of money that's actually flowing around the system. Thus, the demand for products is reducing because less people are buying. And when demand is reduced but the supply levels stay the same, what they hope to happen is that the inflation or the cost of goods and products actually starts to come down. They're still going to increase so much every single year, but they want it to be a more sustainable level, usually around about 2% rather than the near 5% that we've got going on at the moment. Because this is something they can manage. Whereas when it's high inflation like we've got now, they're struggling to manage it. Now, when it comes to inflation, we're nowhere near all-time highs. The 70s and 80s were way worse than what we've got today. But it's still quite concerning that inflation is going up at the rate that it is. So you may be thinking that yes, interest rates are a good thing, we should be raising them because it's going to hopefully curb inflation. It's also going to benefit people who have got money in the bank as well. But as with everything when it comes to monetary policy, when one person wins, another person has to lose. And when interest rates start to go up, it's borrowers who suffer. And the ones who usually suffer the most are people who have got mortgages. Because mortgages aren't fixed rate for X amount of years, like 30 years here in the UK. We don't seem to have that anymore. So people are going to find that their mortgage rates and their mortgage repayments are starting to increase. And the real problem with interest rates and mortgages comes when people are over leveraged. Basically, they've pushed themselves too far to buy the house that they want. And it's understandable why people are in this situation. House prices have grown massively over the last few years, far outstripping the growth in wages. And this means people are having to borrow more money. And there's people out there who are just about being able to pay their mortgages at the moment. Well, what's going to happen when interest rates go up is the cost of their monthly mortgage repayment is going to increase as well. And this isn't going to be good news. People are going to struggle to pay their mortgages. And what happens then? People are either going to have to sell or they're going to have to default. Basically, it can land people in a lot of problems. And it's not just people who have mortgages, people who have personal loans as well. If they haven't got it for a fixed rate over a fixed period, they can find their repayments can go up as well. So basically, borrowing money becomes more expensive when interest rates go up. So it's very much a balancing act that the Bank of England has to do. They want to curb inflation, but they also don't want to put people in a really bad situation by raising interest rates too high and too quickly. So that's a quick breakdown of what inflation is and also interest rates and how the two kind of interact. And I hope it's been helpful. But when it comes down to us as individuals, what can we do to help protect our bank accounts when it comes to inflation? Well, there's only really one thing we can do, and that is we tighten our belts when it comes to our spending. We need to watch what we're spending, whether it's our weekly shop, going down the pub, or the subscriptions we use on a monthly basis. Basically, watch what we're spending and cut out any unnecessary expenses, because there's going to be a lot of people over the next 12 months, if they haven't already, who are going to find that they've not got much money left over at the end of the month. So just watch what you're spending, check your bank account every month, see what you're spending money on, see if there's any areas where you can save money, and hopefully you'll be able to ride out this wave of inflation without too much impact on your life. So I hope this video has been helpful. If it has, a like would be absolutely awesome. Also consider subscribing for more finance related content. So thank you so much for watching, guys. I really do appreciate it. Stay awesome, and I'll see you in the next one.